Welcome traders, it's Friday once again, May 7th, 2021. I'm your host Neil and welcome back to The Big Picture, where we talk about the central themes driving the financial markets and put it all together in a way that makes sense. On deck for today, we're going to go over all kinds of stuff. We're going to look at some sector and market rotations. We're going to look at market positioning. We're going to talk about the current intermarket setup. So stay tuned, lots to get to, and I'll see you guys on the other side. Starting with the intermarket picture today, you'll notice I moved some things around, so I added range rank and volatility rank to this slide here. Super helpful to get a quick read on the current near-term setup in the main intermarket asset classes here. So US equities up across all time frames, so a solid uptrend there in equities with a current range rank of 82% and a volatility rank of 8%. What does that tell us exactly? Well, it tells us that equities right now are near the top end of their short-term, near-term range, right? So 82% indicating that it's 82% of the way to the top of its range. And that's actually as of the close yesterday, Thursday, May 6th. So right now it's Friday, about 10:45 Mountain Time. So we see the price candle here on Friday spiking towards the top of the range right there. So likely closing near the top of the range, if not at the top of the range or even above it today. Volatility rank, on the other hand, goes the opposite way. It tells us where volatility is currently relative to the range that it's been within in the last year. So with a volatility rank of 8%, that means that within the range where volatility has been over the last year, we're 8% above the bottom of that range, telling us that right now volatility is suppressed in equities markets, continues to be suppressed in the equities market. So expanding on that, we get to the US dollar, still in the long-term downtrend, the midterm consolidation, and near-term downtrend as well. So with a range rank of 28%, we can see that in the very near term, towards the bottom of the range as well, and volatility still suppressed in the dollar as well. So match that next to commodities here, which is in long-term, midterm, and near-term uptrends with a range rank of 93% and a vol rank of 27%. It's telling us that commodities have done really well. In the very near term, they've pushed towards the upper end of the near-term range, and that's been on reduced volatility with that vol rank of 27%. So super healthy signs in the commodities market, and that makes sense because it's essentially the exact opposite of the US dollar right now, where commodities is towards the top of its range on reduced volatility. The dollar is near the bottom of its range, also on reduced volatility. So the strong negative correlation between commodities and the dollar firmly on display there. Let's quickly take a look at a chart of the dollar though, because I found this interesting. I mean, still clearly in this long-term downtrend with all this fiscal and monetary support over the last year. Near term is mixed though. We found this bottom in early 2021, and we've made a series of higher lows since then. Although all throughout April and here again today in particular, we've moved from the top of the range to the bottom of the range. So while we're still at a higher low here for now, we are at the very bottom of the near-term range here. So a big move down, another leg lower in the dollar. We'll see if that continues from here or if we mean revert higher. That's going to have implications for the rest of the market. It's going to have a cascade effect, affecting commodities, which are going to affect yields, which are going to affect the stock market, so on and so forth. Lastly, we got the 10-year yield in long-term and midterm uptrends, but moving into this kind of consolidating downtrend here in the near term. So let's take a quick look at the chart there. Moving into the BaroMATRIX, we're looking at the long term here, going back a little more than a year. So beginning of 2020, we see yields plummeting with the coronavirus fallout, consolidating sideways for a while, and then really starting this rally higher in August or so of 2020, peaking in late March, and since then correcting back towards the bottom of its range, kind of consolidating since then. So right now with a range rank of 26%, near the low end of the range there. So yields definitely have more room to run higher from here than to keep pushing lower. And whether yields move higher or lower from here is really going to be dependent on investor expectations of inflation. And those expectations are important, right? Because expectations of inflation are going to affect yields, and yields are going to affect the attractiveness of certain sectors of the stock market, right? So particularly technology and growth oriented stocks are going to suffer in a rising interest rate environment because the underlying narrative, fundamental driver of that narrative is the fact that a lot of these companies are persistently reliant on new debt to continue growing their companies, right? So whenever yields are higher, it costs more for them to take out new debt because the interest rate to service that debt is going to be increased. So the idea is that growth companies, technology companies in particular, are going to be less profitable in rising interest rate environments. So when inflation expectations are on the rise, yields push higher, it makes growth in technology stocks less attractive. On the flip side of that, financials stand to benefit, in particular banks, because as yields rise, they can become more profitable on the loans that they're lending out, on the interest rate that they're capturing on the loans that they're lending out. So rising rates, bad for technology and growth stocks, typically pretty good for financial. So let's talk economic data and the effect that recent economic data might be having on inflation expectations. So we see growth and inflation are still positive broadly, kind of across the main measures that we track here at Market BaroMATRIX. So talking about growth, right now we're hitting the meat of the easy year-over-year comparisons, meaning, right now it's May 7th. So looking back a year was May of 2020 when we were still really not out of the mud, so to speak, of the coronavirus pandemic fallout. So economic data at that time was looking really bad. So anything this year is going to be compared to that time last year. And generally, it's going to look a lot better because of that easy year-over-year comparison. Last week we talked about Q1 GDP, Q1 2021 GDP, gross domestic product, had come out last week. It was up 6.4% year over year. So substantial growth. This week, the interesting note, today we got employment data that for the first time in a while disappointed. We got non-farm payrolls out today at 266,000 versus the expectation of 1 million. So a substantial miss on the non-farm payrolls this week. So what does that do exactly? Well, the fear in the market is that the Fed's next move is likely to start tapering its asset purchases. Right now, the Federal Reserve is purchasing about $120 billion worth of assets in order to prop up the bond market and to keep yields in check, because they don't want yields and overall interest rates spiking too high, because that's hard on the economy. It limits growth in the near term, because again, coming back to the idea of spiking yields and spiking interest rates making new debt more expensive to take out, which slows growth because companies aren't incentivized to take out new debt and to grow their businesses. So the miss on the employment figure here is a pretty big deal because, again, the dual mandate of the Federal Reserve is both maximum employment and stable prices. Jay Powell, the Federal Reserve chairman, had said the previous week that it would take several months of improving employment data for the Fed to really begin considering to put the brakes on the economy. And if you refer back to last week's big picture video, we talked about how the two ways in which they're currently supporting the economy via monetary policy are, on the one hand, their asset purchasing program, where essentially they're supporting the economy with $120 billion worth of asset purchases every month. So that's $80 billion a month in US Treasuries and another $40 billion a month in mortgage-backed securities. That has the effect of both injecting liquidity into the economy, or at least in theory it's supposed to inject liquidity into the economy, and it also also keeps kind of a lid on yields because there's more demand in the US Treasury drives the yields of those treasuries down. Tool number 2 of the Fed's monetary policy is obviously low interest rates, rock bottom interest rates, in fact. So the fear in the market right now is that as the economy improves, it's more and more likely that the Fed will take away the market's crutches, so to speak, right? Take away these 2 tools that they're using to support the economy. The next move that they would likely make before raising interest rates again is that they'd likely start to taper their asset purchasing program. With the underwhelming employment data, that's actually less likely to happen in the very near term. Now, again, Fed Chairman Jay Powell had indicated that he'd be looking to the labor market improving on a sustained basis for several months in a row before they really started to consider tapering their asset purchases. So that's been the big story this week. Underwhelming employment data has cooled inflation expectations moving forward, has reduced the likelihood of the Fed tapering their asset purchasing program in the near term. And that should bode well for the stock market and the economy in general. And more so than anything, it should squelch investor expectations of inflation moving forward, and the Fed will continue to prop up the economy and the stock market via easy money policies. Next up, I wanted to do something a little different and hop over here into the market positioning tab of the BaroMATRIX, get an idea of what the market consensus is leaning into, what they're getting net long and net short. So this looks at the CFTC Commitment of Traders report, which is a weekly report put out on Tuesdays, and it gives us an indication of how the market is positioned in a variety of underlying assets. So this specifically looks at the non-commercial net long position. So non-commercial traders are those who are speculating on the price movement in these underlying assets, as opposed to commercial traders who actually deal in these underlying assets. A corn farmer, for example, might hedge this year's crop and the price that he'll receive in the future on this year's crop by entering contracts in the futures market. But so we're focusing on the speculative investors in these underlying assets with this non-commercial net long position. It essentially just takes those speculative investors that have long positions and subtracts all the speculative investors that have short positions. So we get this net long position. So when this number here is positive, it tells us that there's a net long position, and when it's negative, it tells us there's a net short position. What really matters is when we get to extremes relative to where we've been recently. So we want to be thinking about whether or not the market is unusually net long or unusually net short in an underlying asset. Gives us one more piece of the puzzle and one more way to gauge the relative attractiveness of these assets. You see, when the entire market consensus opinion gets to an extreme either way, it's usually a pretty good contrarian indicator. So if the market is super net short to an extreme degree in an underlying asset, that might indicate that we've reached a bottom in that asset and then it might be a good time to buy. When you couple this information with price, volume, and volatility information, you start to get really powerful entry and exit signals and start to identify high probability opportunities in the market. So in order to measure the level of extremeness as far as the market positioning in any of these assets, we turn to the 1 year and 3 year Z-scores. Now, I'm not going to go too in depth on how these are calculated, so turn to some of our educational content to understand more about Z-scores, but basically it's really easy to use, which is great. Anything above +2 indicates an extreme net long position, right? Anything below -2 tells you that it's an extreme net short position. So anytime you see a 1 year Z-score near +2 or near -2, tells you there's something kind of crazy going on in there. So what I like to do is come into the market positioning table here and sort on this 1 year Z-score column. So then we immediately see what the market is extremely net long and net short in. So right now we see, with a 1 year Z-score of 3.95, the Dow Jones US Real Estate Index has an extreme market net long position. So, 3.95 0.95 is something that happens less than 0.01% of the time. So relative to where it's been in the last year, this is an extreme net long position. When the market positioning gets this extreme, it's usually, again, a fairly good contrarian indicator, letting us know that it might be time that this underlying asset starts to turn around. So when we couple what's going on with this market, extreme net long market positioning in the real estate index, and then we look at real estate price, volume, and volatility data, let's cruise back down to the technical analysis section here. See if I can set it up pretty for you guys. There we go. And we'll go over to XLRE. That's the select sector Spider Trust real estate ETF, right? We see that it took a nosedive during the coronavirus fallout, edged higher from there, consolidated for a couple months, and recently has spiked much, much higher. So we see that price has run up to an incredible degree, has recently found resistance at the top end of its range after making cycle highs, and has settled in near the middle of its range, up about 1% today. So all of that on reduced volatility. If I move myself out of the way here, you guys can see that a little better. Reduced volatility, right, coming out that whole time. So really positive signs from price, volume, and volatility here in the real estate market, save for this very near-term correction, right? So that looks pretty healthy to me, but definitely something to be keeping in the back of your mind that the market positioning is extremely net long. You'd want to see some of that coming out to give you one more tailwind in any investments in the real estate market. Moving on beyond that, what else is extreme right now? Milk, I don't really trade milk, so I don't care about that. We see the E-mini S&P Financial Index at about 1.58. So not the extreme end of extreme, but a notable net long position in financials, which makes sense based on a lot of the other research that we've been doing these last couple weeks. Looking at XLF, which is the Select Sector Spider Financials ETF. Same thing, where price has just skyrocketed near the top end of its range, doing really well as yields have edged higher. Volatility relatively low and moving down as price has moved up. So really positive signs in the financial sector as well, which probably warrants that net long position here in the commitment of traders reports. But let's move down to the bottom of this table and see what the market is extremely net short, right? And I'll move myself out of the way once again so you can get a better handle on this. Rough rice right now is the most extreme net short position at negative 2.7. Again, not something I really trade very often. Notably on this end of the table is gold, which is at negative 2.03, letting us know that this is a net short extreme that is reached less than 5% of the time over this last year. So the market positioning in gold, extremely net short. So let's take a quick closer look at the market positioning in gold here. Control click on gold and you get this drill through function. Will take you to the kind of detailed chart. So we see immediately the 1 year Z-score of negative 2.03. But oddly enough, we see that the net long number itself is positive. So what's important to remember about these Z-scores is they don't necessarily tell you that there's an extreme net short position. It tells you that we're at an extreme low relative to where we've been, in this case, over the last year, right? So while the net long position is still positive, indicating that the market is more long than short, with a current reading of 173,486, that's actually the least net long that it's been in 1 year, or at least close to it, right? A couple weeks back, we got as low as 157,000. So we're at an extreme low relative to where we've been the last year. But looking at the 3 year Z-score of negative 0.20 tells us that we're actually really pretty close close to the average over the last 3 years. So I'll pull this back to 2018 or so. We see that we're more in the middle of the range. You know, here we are right now. So that kind of splits the gap. We haven't actually been net short gold since what's that, kind of Q3 2018. So definitely want to consider the longer term as well. So putting all these things together, what is this really telling us right now? It's telling us that over the last year, market positioning in gold has just become less net long. That seems to be picking up momentum here as that 1 year Z-score is at a negative extreme. Next, let's turn to price, volume, and volatility to continue to shape our outlook for gold. So let's have a look at a chart of gold. We'll just look at GLD, which is the gold shares ETF, and see what that's telling us about price, volume, and volatility. So we see gold really spiked higher this week, but in a long-term downtrend. If we go back to early 2020, actually up since then, we had a really nice rally through the middle of 2020 in response to the coronavirus fallout and extreme devaluation of the dollar via monetary and fiscal policy. But that started to edge lower as yields started to tick up in the middle of 2020. Gold really suffered the last, 8 months or so, looking to have put in a series of higher lows in the nearer term and spiking higher the last couple days. So it looks like that net short position as of last week really was a pretty good contrarian indicator where we're seeing gold pop higher. We're also seeing yields towards the bottom end of their range. So all of these interconnected pieces influencing each other. Now, all that said, I'm still relatively bearish on gold, at least in the near term, because my opinion is that we're likely to continue to see, at the very least, short-term inflation continue to spike. So yields are likely to keep edging higher from here, or at least more likely to edge higher from here, in my opinion. That's going to put downward pressure on gold. Why? Well, because gold is a non-interest bearing asset. So when overall prevailing interest rates go up, gold looks less attractive. So right now, my central narrative is that yields are going to be what drives the market, and yields are going to be driven by commodities, which are going to be driven by the dollar. So it all goes back to the dollar. You can try to tell a linear story about how all this plays out. The fact is, all of these things happen and influence each other at the same time. So in what order all these things play out, I don't know exactly, but gold's definitely an important piece of the puzzle. And you know, if gold does continue to edge higher, I'll happily change my opinion, and I'll be looking to price, volume, and volatility as my #1 signaling tools as to what's going to continue happening. So while this current move goes against kind of what I'm seeing in the market right now, if it continues to develop, it'll start to mold and reshape how I'm seeing the market. That's why it's important to just keep tabs on all of these things so that you can change your opinions as they need to be changed, right? And here's one place that I'm seeing that kind of counters my current narrative. So always staying sharp, always take what the market's going to give you. Don't try to tell the market what it's supposed to do. Jumping back to the market positioning table here, also of note, kind of reaching an extreme net short position is the E-mini Russell 2000 index. So I think of as a proxy for small caps with a current 1 year Z-score of -1.44. So again, not the extreme side of extreme, but a notable net short position in small caps. And we will take a quick look at the detail in there. Control click, drill through, gets us to our chart here. 1 year Z-score -1.44. It is an actual net short position. So the market net short on the Russell 2000 index, again, which I think of as a proxy for small caps, right? So with that in mind, let's take a closer look at price, volume, and volatility in small caps. We'll just come to IWM, which is the Russell 2000 ETF. Obviously, small caps have really done well in the long term. Here's the March 2020 coronavirus fallout, edging higher up and to the right ever since then, until recently, kind of mid-February, we reached this peak where we started to consolidate sideways. In fact, I'm seeing something of a head and shoulders pattern here. Check out the technical analysis videos if you want to learn more about head and shoulders pattern. But it's all amounted to basically just a bunch of washing back and forth over the last couple months. All the while, volatility has been coming out. I'll move myself out of the way so you guys can see that. So as price has consolidated, volatility for the most part has edged lower, with volatility pretty low relative to where it's been recently. So let's put all these things together and think about what it's telling us right now. We have the market positioning relatively low to where it's been. Price is consolidating sideways. We have volume trending down while price has consolidated sideways, and we also have volatility trending down during that time. So that for me sets up a likely continuation of the prevailing long-term uptrend. Prices performed really well over the last year, and this recent consolidation, this move sideways, I see that as more the market kind of digesting the recent gains in there, right? And a decreasing volume during that consolidation and the decreasing volatility once again tells me that the market isn't getting spooked, right? There's just kind of interest coming out of the Russell 2000 right now. But again, usually the prevailing long-term trend is the one that matters the most. And when we break out of this consolidating pattern, it's likely to be to the upside. So putting all that together, this looks more bullish for small caps to me than anything else, especially when you consider plans for more fiscal stimulus coming down the pipe. That would certainly support the domestic economy, and by extension of that, small caps in the Russell 2000. Lastly, let's take a look at the current market rotations. Right now we're looking at the sector rotations. Again, 1 week up top, 1 month, 3 month, 6 month, and 12-month percent returns. Metals and mining taking market leadership once again in the 1 week time frame, with a huge move higher, popping up almost 10% this last week. That's the trailing 5 days. Also the number 1 spot in the 1 month return, the 3 month return, number 2 here on the 6 month return, and number 1 again on the 12-month return. So it's been all about metals and mining, and that again a byproduct of increased commodities prices, which have been a byproduct of a devalued dollar. So again, everything connected, right? As the dollar is devalued, the price of commodities has gone up, which has made companies involved in commodities, particularly in the metals and mining sector, much more profitable and much more attractive for investing dollars. So this week really was about the reflation trade, right? Metals and mining, energy, and materials, all the number 1, 2, and 3 market leaders this last week. And that same narrative we just went through with metals and mining really applies to energy and materials as well, where increased commodities prices has made those companies more profitable, right? As the price of oil goes up, energy companies are more profitable. As the price of basic materials goes up, materials companies dealing in those basic materials are more profitable. So bang, 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 metals, mining, energy, and materials numbers 1, 2, and 3 as far as market leadership, with financials a close 4th. And the same is mostly true across the 1 month, 3 month, and into the 6 month time frames. The more intermediate term, especially with the 3 month and 6 month, where metals and mining is number 1 and number 2 respectively, but you also see energy and materials near the top, and financials in the mix as well. So those 4 sectors of the stock market really outperforming these last 6 months, and into the 12 month, into the long term as well, with metals and mining, financials, materials, and industrials. So industrials in that mix as well. And so that's the reflation trade. The reflation trade has been the place to be this last year. Those sectors of the market have really outperformed, and those long and midterm trends just strengthening this week with a big pop higher in the reflation trade. Also notably this week is technology continues to struggle. The 1 week market laggard, also the 1 month and 3 month month market laggard. So this consolidation really turning into something else. And let's take a quick closer look at technology there. Control click, go to drill through, will take us to the chart. Looking at XLK here, which is one way to measure the technology market. This is the select sector spider technology ETF. We can see technology has done really well since the coronavirus lows, but the last several months it's really just kind of consolidated and corrected even. So these last couple weeks in particular, this last month has been especially brutal on technology. So that really a reaction to, again, investor expectations of inflation, investors assuming that inflation will push yields higher. Yields make it harder for growth-oriented companies to continue growing via new debt, because that debt is more expensive to service. So kind of a linear explanation of something that doesn't necessarily happen linearly, but technology waning in the near and midterm because of this headwind of rising yields and, more importantly, rising investor expectations of inflation moving forward. So does this turn around? I think it will as we reach the final innings of this bull market. I mean, technology is still up. Yes, it's consolidating. Yes, it's ebbed and flowed. But, we also see volume coming down and volatility for the most part staying suppressed. So I think that the longer term uptrend eventually continues, but we're likely to continue consolidating until something happens that cools investors' expectations of inflation and allows tech to jump higher once more. So with all that, let's talk about what to be looking out for next week and get into some action items. The April sell-off in the dollar to the low end of its range has been a tailwind for broad commodities, which for 2 weeks in a row now have really popped higher. With the dollar at the low end of its range, it creates a higher likelihood of a mean reversion next week, which would put downward pressure on commodities. So that's actually, from last week, because the exact same thing was true last week. And instead of getting a pop higher, we saw another leg lower in the dollar and another leg higher in commodities. So that near-term trend really strengthening as commodities push higher again and the dollar pushes lower again. So, it can happen again for another week. But the fact is that right now the probabilities are saying that we're more likely to mean revert back to the middle of the respective ranges. So that would bring commodities lower and the dollar up a little higher. Granted, those would just be mean reversions, and those aren't the long-term trends that I'm looking at right now. Again, the strength in the near-term, mid-term, and long-term is in commodities, which have performed really well, and the long-term trend in the dollar is down. So until I see major inflection points and some follow-through on those things, I'll continue to position myself accordingly. Long commodities and short the dollar. Anytime those things move in the opposite direction, I'll be looking at them as buying opportunities. So with commodities towards the top end of their range, I'll likely be trimming some gains here. And if we do get a small correction in commodities, I will be looking at that as another buying opportunity in the space. Financials are also looking good right here. They're at the top end of the range, so I don't know if I'd be buying tomorrow, but any small corrections in financials I'll be looking to buy as the long-term, mid-term, near-term trends are all up. Market consensus positioning by way of the CFTC commitment of traders reports that we talked about earlier is getting a little long for my taste, but it's not too extreme yet. And with yields currently pretty suppressed and near the low end of their range, the 10-year yield is likely to mean revert higher from here, which is yet another tailwind for financials, which again outperform in rising interest rate environments. So in the very near term, we get another tailwind from a likely mean reversion higher in the 10-year yield. So I like financials right here. Tech consolidating once again. I think that eventually tech pops higher as we kind of reach the final innings of this melt up. But for now, still stuck in this consolidation pattern, and I'll be waiting for something to change in that regard before I enter any new technology positions. Broadly, I'm still long the reflation trade. I'm looking at materials, metals and mining, industrials, and I also like financials here. So I'm going bargain hunting in those sectors, and I'm also still really bullish on commodities. Granted, many of the individual commodities are near the top end of their range right now, so I don't know if I'd be buying today, but still looking to buy any dips in that space and bullish in the long term until that narrative changes. That's all I've got for you today, folks. If you guys like this video, don't forget to hit the like button, subscribe to the channel, check us out at marketbarometrics.com. Until next week, have a fantastic weekend, a very special happy Mother's Day to all the mothers out there, and we'll see you next Friday on The Big Picture.